Well,
Okay.
I mean, we have another beautiful day.
I know.
It wasn't like the snowy Friday where we had a captive audience.
Hey, this is a good audience, though. I'll take
Oh no, it's a good audience. Hey, look, any audience is a good audience.
it. These are all the people that when they get to the end of real estate, they have something to show for it.
Yeah, yeah.
If they do the things that you're telling them.
Well, I'm going to cover a lot more today. I
Okay.
hope. I mean,
Well,
I hope it's going to be an hour. I'll try to keep it an hour.
okay. Well, we can just go ahead and start kicking it off now. Somebody said they got your book yesterday from Amazon. You got to
Oh,
have a book signing. That's a reason to
yeah,
party and get together.
yeah, that's what we need to do. I agree.
Yeah.
You know, it's funny because uh it's called a POD, right? So it's
Mm-hmm.
a pay on delivery. So they don't pre-print the books. They print them when you order them. And so because we didn't have it with a huge publisher, we had it with like a middle of the road publisher. So even the bookstores, if you go into like a Barnes and Noble, you won't see it there. You have to actually order it on their computer from Barnes and
Okay.
Noble. So I don't know.
Okay.
I guess if we ever do it next time, we'll do make sure it's in all the bookstores. But you
Right. You learn right from this one.
yeah, that's
But
just
is it?
Amazon's model. Yeah.
Hmm. Hmm. But I just wanted to, we'll go ahead and get started because I know it's a lot of information. And just, personally, thank you again. And I just want to tell people, we're wrapping up. Hopefully, you're taking advantage and making notes on everything. And just remember to utilize Charlie for, your hard money deals, or if you need money for deals, or if you have deals that you can bring to him that he can utilize to help people. Because at the end of the day, as investors, as realtors, as financial people, we really do believe that we are helping people. That's what we do. That's the core of what we do, is to help families. And sometimes people are people, they get in situations where they do need help. So, you can put yourself in a position where you can be the solution to someone. So Charlie, this is I just wanted to talk about, we had creative financing options was the first one. We had the X's and O's of the hard money lending. Then we had debt service coverage ratio. And now today we have how to use HELOCs, cash, FHA assumptions, and VA assumption loans to purchase properties. So without further ado, Charlie, you can go ahead and take it from there and tell us about all that you do before you get started.
All right. Can you guys see the screen okay?
Yes.
All right. Okay, well, welcome back for all of you that have been with us. And if you're first timers, thanks for joining us. This is the fourth series on our creative financing ways to buy houses. Whether you're an agent and you need a financing option for your toolbox, or whether you're an investor and you're looking for other creative ideas to talk about. So one of the things I want to ask you guys, a couple things, is do any of you returners have any questions on the X's and O's of hard money lending, debt service coverage ratio loans, or subject to loans that we've done in the past? Okay. All right. If there are no questions on that, I'll move forward. But I have to tell you guys, before I move forward, I got to tell you guys a funny story. Nikita, you'll appreciate this. As investors and as realtors, at least for me, I spend most of my days just evaluating deals. So I'm evaluating deals especially on the hard money side for us to loan against. And a lot of times I get deals from investors or realtors that want us to purchase off market deals for our fix and flip business. So all I do is I sit around Monday through Friday, evaluating deals and doing presentations like this. And at night, I attend RIA meetings, real estate investor associations, RIA groups. Sometimes I have to give presentations, sometimes I don't. This week alone, I attended four. But the funny thing about this is that because I've done this for the fourth week, I actually, what I do is because I sit at home and work for the most part, I literally wear the same outfit the entire week, my shirt and pants and everything. And so I had to actually go to last week's recording and I had to figure out which shirt I was wearing so that I didn't wear the same shirt 2 weeks in a row. So I figured I'd tell you guys that funny story, but don't worry, ladies and gentlemen, I do take a shower every day. But because I'm really not out and about during the day, I do. And so I went back and made sure I wasn't wearing the same shirt. So congratulations to me. And the next thing I want to do before I get started is I'm looking at you guys on the chat right now. Can you guys sort of give me a vote uh, and write the number down? How many of you guys is if this is your fourth session with me, can you put a 4 in there and send it on the chat? And then if yeah, Cassandra's 2. Let me know how many you've been to. And if this is the first one, let me know that as well. Because I'm just kind of curious to see how many repeaters I have. Okay, I see a bunch of 4s. I see 4, 3s first. All right, 2, 4. Okay. Yeah, Nikita, good. Yeah, I knew you before. All right. Well, I'm just curious because like I said, this is our fourth week. And so I'm really happy to present today's topic, cash HELOCs. If you guys don't know what a HELOC is, home equity line of credit. We'll talk about VA, FHA home assumptions and just different ways to purchase properties. Like I said in the previous presentations, we did debt service coverage ratio loans. We did X's and O's of hard money. We did subject to financing. And so, Nikita, I don't know where these guys can find it on your end, but if you guys want to find the replays on my end, it's cskyfinancial.com, and I have a tab called events. So the recordings are there. Nikita and Liz, they've been kind enough to send me the tape recording. So I have them on my website, but Nikita, I'm not sure where you want them to go to pick it up on your end.
Except for the second one, I think that was the one we forgot to hit
Yeah,
record.
yeah, the hard money one. But these 3 will be up, so you guys can find it. All right. So for you guys that are new to this, I'll try to keep it quick because we have a lot of repeaters on here who've seen this chart before. This is basically who I am. It's funny because I'm not really into the social media world, but this past month I finally started Instagram because one of my sons made me get on Instagram. So if you guys can give me a quick follow, that'd be nice. I put out a lot of good investing tips, a lot of good reels on investing, so you guys can get some free information on that. So give me a follow on that. 25 years of real estate investing. It's funny. I own a brokerage in Virginia, DC, and Maryland, but I'm only licensed as an ordinary realtor in Virginia. My partner has the broker license throughout those areas, but I do own 50/50 of a real estate brokerage. Own a bunch of companies, investment companies that I'll talk about in a second. And so we'll go through that. I've developed a lot of different projects in my experience as well. Car wash, 3 single family housing developments, a 5-unit, a 4-unit, a 7-unit. I've done a couple of condo conversions in DC. But the thing that I want you guys to point to is that I have a lot of charitable organizations that I'm a part of. I'm president of Catholics for Housing, which is otherwise known as CFH. I helped them buy a 60-unit trailer park in Manassas, Virginia. We own a lot of low-income housing assets. I have a lot of Section 8 tenants. So we're in the affordable housing space. So I've been running that charity for about 10 or 11 years. So that's one of my charitable givings. The other one is, and I think Nikita will appreciate this because this is how we sort of met each other through my son Corey and Anthony. I have a charity called Clear Sky Sports Angels. And what that is we give money to low income youths to give them the opportunity to participate in travel sports like travel soccer or AAU basketball. So my charity does that. So I'm very proud of that. And we're going to have an official launch of that charity this year. I've donated for the last 5-7 years to these various organizations to help families in need, especially kids in need, participate in sports because I'm a sports guy myself, and I feel very strongly that kids need to be able to participate in sports and just because they don't have the money, especially at the higher levels, I think they should have that opportunity and hopefully they can get good friends and good coaches as roles models. So I'm pretty happy about that. And that's basically who I am. sorry to ramble on, especially those who've been on this before. Um, and so this is who we are. I'll go quick. Clear Sky Group, Clear Sky Properties. We fix about 1 to 2 houses a month. I have a pretty good sized residential rental portfolio. Have a industrial truck lot. Clear Sky Financial pretty much is my hard money company. It says 35 million on there. This is kind of an old slide. We have about 40 million out there on the street right now. DC, Maryland, Virginia, North Carolina, Florida. I have another company called Clear Sky Holdings. That company is primarily for tax lien certificate investing in DC and Maryland. Clear Sky Auto, we own an auto body shop, tire shop, and then Clear Sky Education. Recently, we put out the book. Thank you very much, whoever bought that book. I really appreciate it. If you have questions, you got a direct link into me to answer any kind of questions with the book. Roadmap to Wealth, that came out in December. We're launching a video web education series. We have the pilot course out there now. In the next couple weeks, we should have 4 other courses out there. As a matter of fact, one of the courses is called How to Find the Money in Investing in Real Estate. And believe it or not, if you guys have sat through 4 weeks of this, you have gotten about 60 or 70% of that course, because what I've been presenting is just nuggets and tidbits out of that entire course. So you guys have actually sat through the how to find the money. And then I guess indicated, was it about a year ago, 2 years ago? I did a presentation in Lorton on how to find distress assets, which
Yes.
that's another course that we're putting out as well. And we've added on to that. So if you guys were at that course in person, so you've actually taken 2 out of 4 of our courses that are going to be launched in the next 3 weeks. This is basically the roadmap to wealth and residential real estate investing. We have the trademark on this, and this is basically what our book's about. We take somebody with no knowledge and no education in the real estate investing world, and we teach them how to invest. And so what we do is we go through the X's and O's of real estate investing. We show you the different options that you can use to invest, and it's not just buying houses. There's other ways. We take you through financial literacy. We'll teach you about financial literacy, right? How to understand an income statement, a balance sheet, how to figure out your monthly footprint, and then create passive income to replace your monthly footprint so you become financially free. And then once we do that, we teach you how to find distressed assets, create your leads, foreclosures, pre-foreclosures, estate houses, tax lien houses. We show you how to do lead generation. We show you how to create your marketing model, the data that's to you. Then once you start doing that, we'll show you, if you're going to be a fix and flip investor, we show you how to find the money to buy these properties, which you guys have already sat through 3 of these courses. And then once you do that, we'll teach you how to wholesale. We'll teach you how to fix and flip to build your capital stack. But there's many ways of building your capital stack. It's not just wholesaling and flipping. You guys can, use your real estate income for commission income to build your capital stack. But then the most important thing that we teach on the right-hand side is we teach you how to invest your capital stack into passive income. So you might want to build an investment rental portfolio. You might want to build a commercial asset portfolio. You might want to become a hard money lender. Well, if you don't want to do any of these things, then you can actually invest your money in a passive income into what's called a pooled hard money fund, and you can get a good 8 to 9 to 10% return just by putting your money into one of those pooled mortgage funds, and that can sort of help you replace out your normal monthly footprint with passive income. And then the other thing that we teach is tax lien certificate investing. DC and Maryland, DC right now pays out 18% on these guys. Baltimore pays 21%. Montgomery and PG County are between 19 and 20% rate of return on these tax lien certificates. So we teach that as well, because the name of the game is for us to help you guys replace your current income with your passive income. And so that's what the roadmap is all about. And that's kind of really what the book is all about. That's probably not what you guys came here for. So let's go ahead and move on, and we'll talk about some of the house purchasing options. And so if you notice, what's in green is what we've already covered, right? So we covered the hard money component of the financing. We've covered subject twos, which is subject to the existing mortgage. And we also covered this thing called DSCR loans, which stands for debt service coverage ratio loans. And so we've already covered that. So I highlighted that in the green. And so then what I thought is Nikita wanted a 4th series. So I was like, well, what can I put together to help you guys out and to give you other financing options without going over an hour and trying to keep it right at an hour. And so, what I'm going to talk to you guys about today are 4 other house purchasing options: cash, traditional mortgages. And I already know that you guys know enough about traditional mortgages because most of you guys on here are realtors, and a lot of you guys on here you've bought a first home. So we'll talk briefly about that. But one of the things that I really want to stress and emphasize is VA and FHA assumptions, because that's becoming really, really popular these days. Because especially if you're in a market that's tough to sell a house, but somebody has an FHA or a VA loan with a pretty cheap interest rate, then I want to cover how you go about assuming those loans so that you guys have another tool in your toolbox, not only from the realtor standpoint, but also from an investor standpoint. So I want to show you guys how to do that. Also, owner held financing. I'm going to cover what that means, how to find them. I'm going to cover home equity lines of credit. So basically, what I'm going to do, guys, is I'm going to put 4 other investing tools in your pocket so that you can purchase properties. And so one of the things you're probably asking yourself is, I know what cash is. I don't need to know what cash is. And you're probably right. But I want to cover some things on the cash component that will help you guys out. Things like liquidity, how to build your liquidity, right? And using HELOCs to build your liquidity so that the name of the game is, even though you might not have 250 or $300,000 in cash, if you have the liquidity to purchase a house in less than a week for that amount of money, then that's going to help you in your investing career, because most of our best deals that we've ever purchased on the Clear Sky Property side, on the fix and flip side, are deals that we've purchased in a week or less, because I had the ability, because I was calculating my liquidity, to close a real estate purchase in less than a week. So that's a big tool for your toolbox, and I'll cover that as well. And so here's the agenda. I kind of reversed it a little bit. I'll talk about owner financing. First of all, I'm going to include another term in there called shared appreciation mortgages. I'm going to cover traditional mortgages, but I'm going to focus more on the FHA VA side of loan assumptions, home equity line of credits, cash. And so for each particular category, what I'm going to do is I'm going to explain to you what it is. I know most of you probably know some of this stuff, but I'm also going to put in a nice little strategy section, because a lot of times when I talk to folks, whether it's distress assets or whether it's how to find the money, the one thing that they really want to know is, not only do they want to know deal examples and stories, but they want to know strategies. How do I find the distress assets? Or on the money, how do I find the money? But how do I use these different financing sources to go ahead and make certain real estate purchases? When do I use a HELOC? When do I use a hard money lender? When do I use a DSCR loan? When am I going to do a subject to? Does this deal make sense from a subject to standpoint? So I'll go ahead and talk to you guys about strategies at the end of these various subsections. And the other thing too, especially if you guys are new to this is for you, right? Don't be shy. If you have a question at a certain period of time, go ahead and ask it, and I'll go ahead and answer it right away, so that's still on the top of your mind. So go ahead and do that. And so, you never know when you might have a question, and I'll go ahead and answer it right away. All right, topic 1, owner financing. It is what it says it is. What it is where most times the owner owns the property outright. And so they're looking to sell, or you found that owner, maybe that owner has a dilapidated house that needs a lot of work. Maybe they're a hoarder guy, or they've owned it for 20 or 30 years, but they've paid it off. Well, one of the things that you can do is actually show up, talk to them, see if they'll provide owner financing for you to limit your down payment. The best thing about owner held financing is that rate and terms are negotiable, right? So, and I'll talk to you about in the strategy section exactly how you can structure some of these kinds of deals. You could have a limited down payment. Escrow loan is questionable, right? You can ask them to do the escrow for you, or if it's a non-escrow loan, you just simply pay your taxes and insurance separately on the property itself. So an owner finance deal is not bad out there for you looking to purchase your first property or an investment property. And let's say you're looking to purchase your first investment property. This is a great vehicle, because let's say you might have bad credit. You might have, weird incomes. Let's say one year you had, commissionable income that was a lot of money. The next year is much lower. And so the bank takes 2 years average and they might not qualify you from an income standpoint. So this is a good way for you to also purchase real estate. Now they're very hard to find because, you have to have an owner who owns most of their house. Now, remember, I said most of the house. I didn't say all of the houses, all of the house, because there are certain financing strategies where an owner can hold the mortgage and you can simply do a subject to the first. So let's say we had a house in, I'm going to say Dale City, Virginia. Let's say it's a Hiltonian. If you guys don't know what a Hiltonian is, it's 5 bedrooms and 3 baths. Let's say the house was worth, I don't know, $500,000, right? And so the owner only owed $200,000 on it, right? And let's say it was maybe a blighted house or a hoarder home or it needed a little bit of work. Let's say you go to that owner and you say, okay, I'll give you $400,000 for the house, but you're going to keep your first loan in place. You're going to subject to it. But what I need you to do is provide me an owner held finance second trust at $200,000 at 2% interest rate, 30-year amortization schedule, right? Maybe a 10-year balloon. So that's another good way to use owner held financing to purchase a house, but the owner doesn't necessarily have to own the house outright. So there are certain ways that you can go ahead and purchase that house using owner financing, just as long as they have a lot of equity so they can provide it. Now, an owner held finance deal from a mortgage standpoint is the same exact thing as a normal real estate mortgage transaction, right? There's going to be a deed of trust recorded, right? There's going to be a promissory note. And it's just like in Virginia, it's just a normal deed of trust with a promissory note. Maryland and DC, they might call it a mortgage. If you're in a deed of trust state like California, Virginia, it's a deed of trust. If you're in a mortgage state like Maryland, like Pennsylvania, DC and Maryland, then it's a mortgage. So it just depends on what the terminology is, but it's just a normal closing. And so with owner financing, the advantages are a lot. Interest rate, right? You can negotiate the terms. And so on the strategy section that I got coming on next, I will tell you some of our strategies that are very popular. And especially if you're a buy and hold investor, I'm going to present one strategy that you might never even thought about to get you into the buy and hold world that you're going to absolutely love. There's no application documentation, right? There's not even a bank approval. You guys are just showing up. You're buying the house. The owner's holding back financing, and odds are he might not even have an application process. He might not even know what to do. So you're going to have to guide him along those terms. Minimal flexible down payment. Like I said, everything is negotiable. And for the owner, one of the benefits of doing an owner held financing scenario is that they avoid capital gains on the sale of that house. So let's take that same example where I had that $500,000 house. He only owes $200,000 for it, but let's say it's in pretty good condition and he wants to sell it for $500,000 and it's not his owner occupied residence. Let's say it's been a rental for all these years. Well, he's going to have something called capital gains. So if he's owned this property as a rental for, let's say, 3 years or more, he's going to have capital gains. And so by doing an owner held finance transaction, he's avoiding, or he or she is avoiding those capital gain scenario, and it then becomes an installment contract. And so what happens is the owner has to pay on his taxes every year the interest part of that loan that he's doing the owner held financing on, and he's paying a little bit of the principal pay down. So his tax situation is a lot better because he's able to extend his tax liability over, more than a year. So he can extend it as long as the owner held finances in place. And so that's very positive for the owner himself so you can sell them on the idea of owner held financing. Fast closing, right? It's a cheaper closing because these guys aren't going to be sophisticated enough to say, oh, I'm going to add points to your loan. I'm going to add certain fees to your loan that normal lenders will add. And so the closing is going to be a lot cheaper. The disadvantages, though, I'll be frank with you guys, they're very hard to find, right? They could be a short-term loan. Each one of these deals usually has a balloon on top of it, but everything is negotiable. Some of the ways that I always tell folks to find them is that what you want to do is you want to search for owners that have owned their house for more than, let's say, 15 to 20 years. So if they've owned the house for 15 to 20 years or plus, then odds are they have a lot of equity. And oh, by the way, the caveat is that they haven't refinanced within that 15 or 20 years. So odds are they either have a paid off house, especially if it's, 30, 40 years that they've owned it. So odds are they either have a paid off house or they have a very low mortgage amount. And so that's a good way to go ahead and find these guys and source these deals. Okay. So owner finance strategies. So what are some of the things that we like to do in trying to find these guys, right? Obviously find a distressed asset, buy it for 60 to 70% of the after repair value. And what I mean by a distressed asset is I don't mean it's a financially distressed asset. I mean that it's a condition distressed asset. So maybe if it's an out-of-state owner and the house is vacant because the last tenant just moved out, maybe a tenant is in there absolutely destroying the house. Maybe the owner still lives there, but it's in not only is it in blighted condition, but the owner might be a hoarder, right? So there's a lot of different ways where you can go and find these distressed assets from a condition standpoint, and you can simply write them down on your list and try and target market that person, that property owner, and mail to them and call them and send emails and try and buy it at that cheap price. Now, one of the things that we like to do, and this is a great buy and hold strategy, as long as you got somebody willing to do an owner finance scenario. One of the things that I like to do is, let's say you've got I don't know, house is worth $300,000, right? The rental might be $2,500 per month on the rent. The owner owns it outright. Well, if the owner wants $300,000 for it, well, since when they move out, you're going to put a tenant in there at $2,500 a month. Well, they're offering 300,000 for it, asking, well, why don't you pay them $330,000 for it with terms? And so then you're probably asking me, you're saying, nobody will do that. No one's that crazy. Why would I buy a house 10% higher than the market price? And my answer to you is, as long as you can exchange the note for terms that work for you, then it's going to work. So one of the terms that we like to offer is, hey, I'll give you, 330 for that house when it's worth 300, but you're going to give me a 0% loan and you are going to finance it with what's called a 20-year AM schedule. So I'm going to make you 240 payments at 0% financing. Then what you do, you turn around, you rent it for the $2,500 a month. You then in turn take that, whatever that money is, right? Whatever you owe him for that loan, you then pay him that loan, because remember, guys, it's a 0% interest loan. So if you're paying him $2,000 a month, right, it's going to take you a year and a half to recoup that 30,000 that you overpaid for it. But then everything else is gravy, because every single rent payment that you receive is going to this guy anyway. But then what happens is after that year and a half is up, every single payment you make him is going further to reduce that principal. Reduce, reduce, reduce. And you're also making a positive cash flow by renting it out. Okay. So that's pretty simple. The other thing that you're going to have to keep in mind is that if you're receiving $2,500 a month in rent, you're going to need to pay the property taxes and insurance separately. So just keep that in mind, that you're going to have to do that. And that's going to impact your cash flow a little bit, but at least you can have a cash flow performing asset. It's getting rented out. You're paying this guy, whatever, $2,000 a month towards your principal, nothing goes toward interest. And so you're going to build up nice equity in that house in a 5-year period of time. And even if you overpaid for it, who cares? It doesn't matter. Just keep the property performing with a good tenant. You're going to be fine. And you're going to start building equity as well as paying down that mortgage. And the other thing I want to cover on owner financing strategies is on the fix and flip side. And again, this is a very creative way to use owner held financing techniques. And this is what's called a shared appreciation mortgage. And this is more along the lines on a fix and flip strategy. So let's say I got that same house that's worth $500,000. Let's say the owner owns it outright and he's a hoarder, right? It's in blighted. The property's in terrible condition. It's going to need $100,000 worth of work. Well, remember, it's worth 500,000. Well, I'm going to go to him and I'm going to say, all right, I'm going to buy your house for $300,000. You're going to finance that $300,000. But what I'm going to do for you is I'm going to renovate it and I'm going to fix and flip it. What we're going to do is we're going to split the shared appreciation, right? We're going to split the profit when I'm done. Okay. I go down a contract for $300,000. He's the first trust holder. Again, negotiate the terms on that. And then let's say, okay, I'm going to pay you at, I don't know, 5% on your $300,000 interest only. But you know what I'm going to do? I'm going to share with you 25% of the profit when we're done with the fix and flip. And so at the end of the day, you bought it for 300, you put $100,000 into it, 400,000. You have $100,000 profit, of which you're giving him $25,000 plus the $300,000 that you owe him on the first trust, plus at a 5% interest rate. And so that's the definition of what a shared appreciation mortgage looks like. And so that's a win-win transaction for everybody. You know, the owner might say, well, instead of a 25% share, I want a 50% share. And then you can negotiate any way you want, but that's a good way for you to get into the property because remember, you're getting into this property for basically no money down. He's holding the $300,000 note. You know, the only thing you got to put out of your pocket is $100,000, but you don't really need to do that because you can find a hard money guy like me who might put up the $100,000 for your renovation. So there you go. You just created a profit of $100,000, which you're giving back either 25 or 50, and you've used none of your own money. So that's a really good way of using the owner finance section to go ahead and make yourself a little bit of money, not only on the buy and hold side, but on the fix and flip side. All right. Any questions on owner held financing? I'll try and speed it up a little bit, but I think I'm on track. I don't, let me look. I'm not even monitoring the chat. Are you guys still awake? Yeah. All right. No questions on that. All right.
We're here.
All right. You're here. Okay.
I think you're gonna have some questions in the end, though.
Oh, okay. All right. No. Okay. Oh, sounds interesting. Can we get a recording of it? That's great. Yeah. There'll be recordings out there. No problem. All right. Topic 2. I'll quickly cover this just because, like I said, most of you guys are realtors on here and or homeowners, and we don't need to belabor the point on what a traditional mortgage is. And so we'll go quickly through this. Obviously, you guys know what a mortgage is. It's basically a lien on the property where you pay the bank back or an owner held back an interest rate, a payment every month. Some states call it a mortgage. Some states call it a deed of trust. Just know the laws of whatever state you're in. Obviously, there's a promissory note with the mortgage or deed of trust that documents the interest rates, the amortization schedule, and so it also specifies the default clauses, the late fees, and all that kind of stuff. So understand the promissory note along with a deed of trust. Just some terminology. Loan to value, you guys know what that is. An investment terminology is called after repair value. You'll hear it ARV. When I do hard money loans, I'll go out at a percentage of the LTV to the ARV. I don't really care what you purchase it for. So I'll loan into the after repair value, which is why we're so popular. Another terminology that you might not know, I don't know if you do, loan to cost. And basically this is on the investment side. The loan to cost is the purchase price plus the cost of the renovation. So let's say it's a $300,000 purchase, $100,000 renovation. My loan to cost is 400,000. And so if I'm lending at, let's say 90% LTC, then I'll lend 90% of 400,000, which is $360,000. So that's just another parameter that I use. What's a point? Most of us know what a point is. It's 1% of the loan amount. So if I have a $200,000 loan, 1 point is $2,000. Obviously loans can be interest only. One of the things that you might want to do, especially for me on the hard money side, all of my loans are interest only. I don't have a principal and interest option. So all of my loans are interest only. Obviously, most of the normal mortgage loans are 30-year AMs, 30-year amortization schedule. Mortgage concepts, understand the AM schedule. We talked about this a little bit on the DSCR loan, where you could actually build your own amortization schedule, whether it was a 30-year, 25-year, 10-year, 15-year AM schedule. So you could build in that AM schedule, all depending upon what your end goals are with the property. Do you want to pay it off faster? Do you want to pay it off a lot longer so that you can maximize the monthly cash flow? It just depends on what you want to do. Again, interest-only loans, payments are interest-only, not the principal balance. Traditional mortgage, right? You guys understand this. Qualification process, right? Income verification, credit check, debt coverage ratios for you, debt coverage ratios for the property. So it's a pretty cumbersome process to buy a house, especially if you're talking about investing options. This is probably the most documentation cumbersome process of all the financing options. Closing process, disclosure timing, document delivery timing, funding timing. The reason why I put that in there is because as we're going to cover underneath the loan assumption charts, is that if you're an investor, right, one of the things that you got to do if you're buying a house is you're going to have the need for speed. And so you're going to want to you're going to want to close on a house fairly quickly, which is why you use your investor options. But buying a house as an investor property using a traditional mortgage is a very good way to do it too, provided you've got 20 to 30 days to close that loan, because you're going to have a loan with a better interest rate, and you're going to have a loan maybe with a pretty low down payment. So this is a good option to purchase investment properties as well. But that's really not why I'm covering this. Um, and here's why I'm going to cover this is because you guys as agents and even investors, this is a very good investor tool as well. But you guys as agents is you have to understand what's called the loan assumption process. And the VA and the FHA have a loan assumption process. I'm not 100% sure that USDA has it, but my guess is because FHA does it, USDA will do it as well. And for you guys who don't know what USDA is a loan program, United States Department of Agriculture. It's pretty much USDA loans are for properties that are in rural areas. I think the guideline is 25 to 30 miles away from a metropolitan city. So anything 30 miles out of the DC suburbs might and will qualify for a USDA loan. So I'm pretty sure USDA has a loan assumption. I'll look into that, but that's not one of my charts. One of my charts is I want to cover a VA loan assumption and an FHA loan assumption. And the question is why would I want to do this? Well, there's a lot of ways. There's a lot of reasons. And what we're in, guys, is we're in a very high interest rate environment right now compared to 2 or 3 years ago, right? 30-year fixed, what is it at? 6.25 to 6.5. It's fluctuating now. It was at 7.5 3 or 4 months ago. And so a lot of times, if anybody took out a mortgage between, let's say, 2018 and 2023, beginning of 2023, odds are they have a very low interest rate on their mortgage. And so this is one of the reasons why you want to go ahead and assume that loan if you can qualify to do it. And the key is if you can qualify, right? Because unlike a subject to the mortgage process, there is no bank approval. You just basically take over the payments of that subject to deal. You don't have to get qualified, and so and you can close it in a week or less. In this case, we are assuming the loan. So what needs to happen, especially on the VA side, and you're probably asking yourself the question that says, well, I'm not a veteran. I don't have any veteran eligibility. Why do I care about a VA loan assumption? Well, the answer is that you don't have to be a veteran to assume a VA loan. All right. Anybody can assume a VA loan, but you have to get qualified through the Veterans Administration, Department of VA. They have to qualify you. So you're going to have to fill out an application. You're going to have to give them tax returns. You're going to have to get your credit pulled. You're going to have to do income verification, right? So there's no, so there's no subject to, there's an assumption. All right. Now, what happens though to the military buyer is that if it's a non-military buyer, they can assume the loan, but that person's VA entitlement does not go away. The only time the VA entitlement goes away is if a veteran assumes that loan. So that's a little tricky, but with the VA entitlements being so high these days, I don't know exactly what the VA entitlement amount is. I think it's $1.2 million. And if you're assuming a $300,000 loan, they still have about $900,000 in VA entitlement. So it's not that big of a deal, but it could be that big of a deal if, the VA has a $700,000 or the VA buyer or owner has a $700,000 house and they want you to assume a $600,000 mortgage and somebody that has no military service assumes it, that might be a problem. So keep that in mind, right? And then in most cases with VA assumptions, the lenders do not have to approve. Now that's going to be a little bit different on the FHA assumption process. And so you just have to understand that. Down payment could be required if the price exceeds the mortgage balance. So if you're a realtor and you have a VA seller, and let's say you have a higher priced house and you may be having a hard time moving that house. Let's say it's a house down in, I don't know, Fredericksburg or Stafford or out in Charles County, Maryland, wherever you are. Let's say somebody's trying to sell a house for $700,000 and they own a $500,000 first trust VA at let's say 2 7/8, simply just use that as a carrot to bring your $700,000 buyer in there. They'll put $200,000 down and they'll assume the VA loan of $500,000. I mean, that's a pretty good carrot to help you get that house sold, even if that $700,000 house might only be worth 675 or 650, right? It's a good way to help you get that house moved. And so that's how that works. The qualification process, this isn't a week-long process. This will take 30 to 45 days. And I don't know if there's a shortcut. It just depends on the VA backlog on their assumption side. So I would count on at least 30 days of doing an assumption, maybe. So keep that in mind. Income verification, credit score, down payment, man, they qualify you on all those things. It's just like if you're applying for a loan. And then you will have what's called a 0.5% VA funding fee that you'll have to pay. So if it's a $500,000 loan assumption, they're going to pick up $2,500 from you. So keep that in mind. Again, same thing, FHA loan assumption. Basically, it's a similar process, right? You're going to assume the remaining payments of the loan. But like I said, the reason why you would do this is the same way, lower interest rate on the loan. Anybody can do it. You just got to qualify. And so, but I've got this in here. We could probably take it out, but loan before 12/1/1986 has no restrictions on assumability. But I think the number of loans that are out there before 1986 have got to be less than 1%. Maybe they had a 40-year AM or something like that. I mean, who knows? They're not going to be very many of those. Post 1986, lender participation is required. So before 1986, there was no restrictions on assumability. The bank didn't have to approve. Now you have two levels of approval. You've got the FHA that has to approve it, but then you also have the lender has to approve it as well. So you've got two levels of approval on the FHA loan assumption. Again, down payment required if the price exceeds the mortgage balance. So just keep that in mind. But nowadays, people are willing to put up pretty good sizable down payments if they can get an interest rate at 3%, 2 7/8, 3.5. I mean, it's worth it to them, right? Because they're saving a lot of money on the monthly payment. So, that it's worth that to a lot of people. Qualification process, again, 45 to 90 days. And in this case, you might be able to get away with 35 days, but usually it's 45 days. It's a little higher than VA because you have two levels of approval, one with the FHA and then one with the bank. But they do consider, like I said, debt to income ratios. They're going to talk about debt to income ratios on the VA as well. You have two debt to income ratios. You have a debt to income ratio with your personal finances, including your house payment, but then you have a debt to income ratio on the house payment itself. So you're going to have two different debt to income ratios that you got to qualify underneath. Credit score. The last time I did this chart was about 600 and above for FHA on the loan assumption. It could be a little bit lower now, but that's what it was. Traditional mortgages, we covered most of this, what the advantages and the disadvantages are. I want to talk about a little bit of traditional loan strategies, especially on the assumption side. Again, if you're going to do a fix and flip on it, the problem is though, if you buy a distressed asset that has a VA or an FHA loan assumption, if it's a financially distressed asset, they might need you to close in 1 or 2 weeks, so this might not work. But if they have 30 to 45 days to close and you want to assume it, that's a good idea. But one of the things that you want to do though is if you're an investor, you pretty much utilize this tool for your buy and hold investments. So you assume the loan at a lower interest rate, and then you rent the property for a certain cash flow. And because the interest rate on the loan is much lower, you're going to be able to get a lot more positive cash flow from your tenant. So usually if you're on the investor side, this is a good tool to use as a buy and hold. If you are fortunate enough to get one of these scenarios where you're doing a fix and flip, then this is wonderful because the interest rate on the debt that you're paying is a heck of a lot cheaper than a hard money lender. You could be comparing a 3% VA or FHA assumable versus a 12% interest only hard money loan. And that could save you 9% every month on a monthly payment. And that's going to dramatically reduce your holding costs on your fix and flip, which in turn is going to have you make you more money on the fix and flip. Any questions? Nope. All right. We will move on. I'm doing okay on time, I think. I'll be quick. Holy smokes, 15 minutes. Sorry, guys, I'm talking a lot. All right, next topic, HELOCs. What is it? Home equity lines of credit. a valuable tool. And I'm going to explain to you how valuable it is in a second when I talk about cash and I talk about liquidity and I talk about how you need to calculate your liquidity every month, every 3 months. So basically, it can be done on a single property or a portfolio of properties. And the reason why I know this is because we, throughout our lives, our careers, we have used home equity lines of credit I've used it to further finance my hard money business because we have a pretty good sized rental portfolio that's just sitting on a lot of equity. And so we're the kind of guys who don't like what we call dead equity to just be sitting out there. We want to be able to, get that debt equity out, right, in the form of a HELOC, and we want to be able to utilize it for future investment opportunities. And so that's exactly how we've done it. So I've done it on both a portfolio of properties, and I've also done it on my single family houses that I've ever owned and occupied, and I've never sold one. I've always just rented it out. And so I'll show you guys in a second how we utilized home equity lines of credit to further our investing career. Lower interest rate, caveat that because right now most HELOCs are variable rates. They'll lock you in at a low rate, and then they'll as interest rates fluctuate, your HELOC payment is going to fluctuate because the majority of the HELOC payments are interest only for about 10 years. And then if you had a HELOC out there for longer than 10 years, then the bank is either going to make you get a new HELOC to pay off the old HELOC, or they're going to do what's called, they're going to term you out. And so when they term you out, that becomes a principal and interest payment at the prevailing interest rate. So be careful. Right now, rates are up a little bit on HELOCs. So just be cautious of that. I've done HELOCs, they've been very low in rates. And one of the strategies I used to do was if I had a HELOC at 3%, let's say I had $200,000 HELOC, and a lot of my other hard money investors would do is they would get a HELOC, let's say $200,000 at 3%. They would invest it in my pooled mortgage fund, and which is paying between 8 and 9%. So if that fund was paying at 9% for that $200,000 and they were able to borrow $200,000 off their HELOC, they were making a free 6% loan on that $200,000. So they were making $12,000 a year on that money, which is $1,000 a month of utilizing their debt equity in their house. So that was a strategy that a lot of our investors used to use. Now that the rates went up, they're not using it that much anymore. But as rates go down, they're going to start doing that time and time again. And then basically what happens is that the way a HELOC is calculated, and I've got an example here coming up, is that it's 75% of your house's value, right? I've got 75% of the equity minus other debt, but what they do is they compute 75% of your house's value, appraised value. They get a number. They then subtract it, right? So no, I'm sorry. Yeah, they take 75% of the value of the house, right? They get a number, and then they subtract it from the amount you owe, and that's your available line. So I'll go through an example here in a second on exactly how they calculate it. And so here you go. So let's say, for example, you've lived in your primary residence for 10 years, right? The market's been good and it's appreciated. The value is now is $600,000, right? But your first mortgage payoff is $250,000. And so one of the things that I haven't explained that I need to explain is that most HELOCs are usually in second trust position. But if you have a house where the loan is paid off, then you can certainly still get a HELOC and it could be in first position. So it doesn't necessarily have to be in second position, but most of them are, right? So keep that in mind. And a HELOC isn't actually the same as closing a loan. All it is a checkbook. It just says, let's say you have a $200,000 HELOC. You might owe nothing on it, but you have a checkbook where you can write for $200,000. That's basically what it is. All right. So your house is worth $600,000. You owe $250,000. So what a bank is going to do is they're going to multiply the 75% times 600,000, right? So they'll give you a 75% HELOC. They see that you have 350, right? So they'll take the $600,000, they'll multiply it by 75 cents. They're going to get $450,000, right? They then take that $450,000, subtract it from your 250, and they'll approve you for a $200,000 home equity line of credit. Now,
the way things look, Oprah,
but
my family on your show.
Oh, all right. I think we got a little interference, but that's okay. So then what they do is, so once you have the $200,000 HELOC, they'll say, okay, now, one of the things that you need to realize is that certain banks are going to offer a higher percentage for your HELOC. So they might go 75%. Some of the credit unions might go all the way up to 90%. So let's say if I have a credit union that went to 90% HELOC, they'll go 90.90 times the 600. They'll give you 540 minus your 250. So you could get a much higher home equity line of credit. So you just have to understand what their ratios are. Is it 70%? Is it 75%? Is it 90%? Are these institutions even offering HELOCs? Because some institutions don't offer HELOCs. Seth, you have a question? Put it in the chat, or you can say it. Unmute yourself and say it.
Okay, yeah. Charlie, I thought HELOCs normally operated by a variable percentage, meaning the current interest rate plus a little, a little bit over. Are you saying that, some HELOCs will be a flat rate?
Nope,
that
no,
a
you're right.
bank
No,
Okay.
you're absolutely right. All HELOCs start out at a small teaser rate, and they'll adjust with the prime rate. So they will adjust over time. So you might be
Okay.
fixed in for, let's say, a year, but then it might adjust after the year, depending upon what rates are doing. Matter of fact, it will adjust both ways. It will adjust on the upside as the rates go up, and then it'll adjust on the downside. So what you guys have to do is just make sure that when you take your HELOC out, that you really review your home equity line of credit documents and understand how they're raising and reducing rates, what the well, the LIBOR doesn't exist anymore. Just what the rate indicator is that they're adjusting the rates based on, and then understand what how they're adjusting it. And so the more educated you are about your HELOC, the better that you'll be, because right now HELOCs are adjusting on the upside. So my HELOC has been going up, going up, going up. But lately, since some rates are coming down, they've been adjusting a little bit on the downside. So you're right, Seth. That's exactly right. It is a variable interest rate, but the advantage to a HELOC is that for the first 10 years, right, it's going to be an interest only payment. And then if you've had that HELOC out there for more than 10 years, then it's going to term out. And so they're going to make you term it out. And so you just
Correct. And I'm getting ready to be turned out on mine. And I don't know how about shopping, let's just say for a lower rate on the next HELOC that I have to try to take out. So we can either talk about that
Yeah,
another
and so
time.
no, and so that's interesting, because one of the things that's going on right now, and you guys have got to be really on top of your P's and Q's, is that banks change their requirements all the time. Like I know, for example, Wells Fargo they don't offer HELOCs anymore. Bank of America, some of the bigger institutions do not. Even some of the credit unions are stopping their HELOCs, but a lot of the community banks are. So a lot of community banks in your area, and I haven't really done a discussion on what a community bank is in soft money, but a community bank is basically a smaller bank that has 4, 6, 7 branches. So go in and get a relationship with those guys, because some of the community banks are offering home equity lines of credit. And so it just depends. So depending upon the credit boxes of these banks and institutions, and depending upon the economy, they will fluctuate with their loan products as well as their interest rates over time. So this isn't a one size fits all. You really have got to do your research into the institutions and find out what their lending appetite is, because certain institutions, their lending appetite varies. It varies with mergers and acquisitions. It varies with their chief credit officer, chief lending officer. These guys make policies all the time. So these banks are always changing their appetite. So you guys have got to really be on top of this. But home equity line of credit is a very good way to build up your liquidity, and I'll cover that in a second. Advantages, interest rates, they're an advantage, but they're also a disadvantage. And so I guess I got to do full disclosure. And I hope he doesn't mind this, but that guy, Seth E., he's one of our investors in our pooled mortgage fund. And he was actually doing the arbitrage of his HELOC into my pooled mortgage fund. And so a couple of years ago, when rates were running around 3% and we were paying out pretty good returns, he was making a really nice arbitrage off of his home equity line of credit, which I call it free money. And so he did that very successfully for about almost 10 years now, I think. So that's why he says he's getting ready to term out, because he's been investing with us for, I guess it's been 10 years now. God,
Yep.
we old.
Very good.
We are old. All right. Just remember the disadvantages, guys. During recessionary times, banks can term out credit lines and or cancel. And I need to put another caveat on that, or they can stop that product in its entirety. So just be careful, do your research. My guess is if certain credit unions and big banks aren't doing it, I would definitely go to the community bank level, because the community banks make decisions all the time. They change decisions. If they like you as a client, even if they might not be offering a HELOC, if you're a big client with that bank, they're going to give you a HELOC, trust me. Strategies. One of the things that I've done over my career is anytime that I've owned a owner occupied house that has a normal mortgage on it, and if I bought it at a good price, or if the property is appreciated, if I'm thinking about taking my owner occupied house and turning it into a rental, what I do is I put a HELOC on that house and I get as much of a HELOC room as I can. So if the banks are aggressive and they're offering 80, 85%, then I'll go with that bank and I'll keep that out there. Apple Federal Credit Union was offering it a few years ago, but I don't know if they are anymore. They're at 90%. And so I got a 90% HELOC on my house when I was an owner occupant. And so then what I like to do is, let's say I'm going to put that house as a rental. I'm going ahead and buy another house and move into it, keep my other house as a rental. Remember that HELOC is still in place. And then I'll buy that other house into equity. As the market appreciates a little bit, if it does, then I'll simply get another HELOC on my new owner occupied house. And I'll keep trying to build up HELOCs when I'm an owner occupant. And then I'll use that as a down payment for another property to purchase. So that's just a good way of using the HELOCs to buy properties. And I've done it successfully many times in the past. And like I said, another way for us is in our rental portfolio, we're always trying to reinvest our debt equity. Right now, my rental portfolio is running, I'm at 45% LTV through Sandy Spring Bank. And so I've got, 25, 30% equity room to borrow against it and to further invest that kind of money. But again, it's just finding a bank partner that wants to be that opportunistic and partner with us. We haven't really started shopping it yet, but we have 30% availability on a home and equity line of credit on a pretty big size rental portfolio with quite a bit of equity. So we on our side have a lot of room to use these HELOCs to help us out on the investing side. So like I said, it's a very powerful way. I know a lot of you guys know what a HELOC is, but just for those of you guys who don't know what it is, maybe I helped you with a strategy on how to further utilize it to help you make you more money. Any questions on that other than Seth on the HELOCs? All right. Last topic. I'll try and be quick. I got a minute, so I might keep it a little longer. Cash, buying houses in cash. Obviously cash is the ability to use all cash to purchase real estate, but cash typically comes from different sources, right? It's the easiest form of financing, no complications, and you get a deal closed. One of my first investment properties that I ever bought was because I had these huge gold line credit card lines of about $300,000. There was a pre-foreclosure, foreclosing trust, $120,000. The guy wanted 130 for it, but I had to close in a week and a half. And so I took down all my gold card lines so I could close it in cash, bought it a week later in cash. Once I owned it, I then went ahead and refinanced it with a normal loan. Of course, I couldn't get any cash out on that loan. I just got a simple sale price, and I just paid off my credit cards. And then I owned a house for 130 that was worth $200,000. So that was one of the first ways that I bought an investment property, and I didn't even really have much cash to my name, but that is considered cash. When I purchased it, I owned it outright. Advantages: quick close, ability to win the deal. Disadvantages: by using cash, not scalable, non-leverage return, could have a lost opportunity on other deals, and it's very difficult for new investors. And this basically it shows you kind of what a new investor looks like. Access to cash increases as we become better investors. So at the very beginning of my career, I had no cash, not much, but I had a lot of credit card room. I was an engineer by trade. I had a really good technology job and I had great credit. So I was able to build up my gold card lines, which had a 3% cash advance fee, which is 3 points. So for that $120,000 that I used to purchase it, it cost me $3,600 in cash advance fees. But I didn't really care because I came back and refinanced for 130, paid them all off, paid the owner out his 10 grand or whatever. But at the very beginning of my career, I didn't have much cash, but I had credit card availability. And then as you get older and more mature in your investing career, you're going to have personal lines of credit. You're going to have HELOC availability. You're going to have stock account lines. You're going to have different lines to enable to pull cash. And then you'll also have more cash in investments. So it's just a maturity process. And so eventually, you're going to have a big cash component enabling you to buy distressed assets at a faster and quicker basis. And so what I want to talk about is really quick is liquidity. What is it? You have to really understand this, because if you're going to further your investing career like you need to, you've got to understand liquidity. So basically, liquidity is a measure of monies that a person has on hand to invest and meet immediate or short-term obligations. Basically, it's how quickly can you get your hands on your cash. In simpler terms, liquidity is to get your money whenever you need it. As investors, you need to know your liquidity so you can move on a deal. At the very beginning of my career, I was calculating my liquidity on a monthly basis. And the reason behind that is, even though I didn't have much cash, I was constantly applying to gold cards so I could get these cards, right? These $20,000 cash advance limits, 10,000, 15,000. So I was constantly monitoring my liquidity. So as my cash position went up and my investments went up and my HELOC value or my property value went up, I was just doing more of a liquidity calculation. Now, what we do is on my hard money business, we calculate our liquidity daily, because I've got too much money coming and going as far as loans coming in, loans going out. So we're calculating it daily. Personally, I don't really calculate my liquidity that much anymore, maybe once a year. But you as new investors, you've got to be calculating your liquidity as often as you can so that you can see. The whole idea is, let's say I have a pre-foreclosure, I need to buy it within 5 days or less. How much of a property can I buy? And it's very important for you to understand that. And so here's a chart on liquidity and how we calculate it, right? Basically, it's your cash on hand. It could be money market. It could be checking. It could be savings. It could be that CD that's coming due in the next month. Plus your HELOCs. We talked about that. Plus credit card availability. But I caveat that, be careful. Use it. Don't use it to buy a boat, and don't use it to take a vacation. Use it for investment purposes only, but you got to be smart about it. Other bank relationships, borrowing power against brokerage accounts, and then your money raising ability from your friends. And so that's basically how you do it. And so you need to keep track of that monthly, every quarter, every 6 months, and then watch that liquidity go up, and then make sure that, you're a pro investor. That's how you go from a beginning investor to a pro investor. Your liquidity. How do I become bankable? Credit score, build your credit score, create your personal financial statement, balance sheet, right? Income statement is important. It's your budget. If you're a corporation, you need your income statement. Tax returns are important. Why am I telling you guys all this? Is because this is at the end of the 4-week finance discussion. And you guys have got to start becoming bankable as well, because you want community bank relationships. I didn't talk about it, but that's one of the things that you want as well. Key takeaways: build credit. One financing source does not fit all. I've covered probably 8 of them in the last 4 weeks. So you have a lot of tools in your toolbox, not only as real estate agents, but as investors. The property purchase circumstance will dictate what source to use, depending upon time to close, depending upon how much a cash component you got to put up. There's a lot of different scenarios. And remember, you can use a combination of money sources to fund a deal. You could use a subject to with the owner held financing with the hard money gap. So you can use 3 different funding sources on one deal. So just understand these different financing sources and how they can help your investing career. And I think that might be it. And so now we're ready for questions. It's 2:05. I probably got another 5 or 10 minutes before I got to blast to another meeting. But I want to thank you guys for being on this call. I want to thank you guys who've been here 4 times. And it was a pleasure to help you guys out, and hopefully I can help into your successes in your investing career.
There was some questions in the chat.
Yeah. Okay.
But I think Seth put a link in there.
Okay. Link to the recording is in there. Does anyone offer HELOCs on investor properties? Yeah, that's a great question. What you need to do with that is you need to go and establish a relationship with the community bank, because the community banks are going to be a lot more flexible in those home equity lines of credit on investment properties. So yes, I would talk to your community bank, depending upon where you are where you are located. I'm not exactly sure where you're located. Wow, that's good. No, that's good, guys. Like I said, I hope you guys. Okay, which credit cards are best to apply for business and liquidity? That's a great question. So what I would do is I would go. Capital One Bank used to be good. Chevy Chase used to be good. I haven't done this in quite a long time because when I did it, it was about 20, 24, 25 years ago. So I'm assuming, Kiona, that you have a really good credit and you got a good income history. So if that's the case, yeah, I would try with the bigger banks, the Bank of Americas, the Wells Fargos, the Capital Ones. Try that, and those will be good. But what you want to do though, you don't want to get a credit card where, let's say, you have a $30,000 line of credit, but only a $5,000 cash advance. Do not do that. You need to make sure that the cash advance portion of that credit is much higher percentage. So if it's a $30,000 line, I would like to see at least a $20,000 credit line, cash advance line, so that you can build this up. But like I said, you got to be very disciplined about it and make sure you use that to buy, pre-foreclosures, distress assets of some kind, whether it's a tax lien property or an estate property, so on and so forth. And so just use it wisely. And I think that's it. You're welcome. All right. Guys, thank
Okay.
you. It's been a privilege.
Thank
Nikita, thank you
you.
very much. Exit
I know
Realty.
you gotta go.
Huh?
I said, I know you gotta go, but we appreciate it.
Thank you, guys. Hope you learned something.
Yes.
Call me anytime. Follow me on Instagram. You'll laugh